What we'll talk about today is convertible term insurance. We'll talk about what it is, how it works, some limitations that are very important to be aware of, and then we'll look at an example of someone who is interested in a convertible term policy because he wants to convert it to a whole life insurance policy at a later date where cash value will be his goal. So let's start with what is it? It is a term life insurance policy that I can purchase right now. When I purchase the term policy, I am locking in my health rating. So if I get a 20-year term policy, the death benefit is $1 million, and I put a conversion rider on it or an extended conversion rider. What that means is that I can convert that term life insurance policy to whole life insurance at a later date. Now, the benefit here is that when I convert it or switch it over to whole life insurance, I don't have to go through any medical underwriting at all. This is how it works. So if you get a term life insurance policy right now at the age of 40, and you get a preferred plus health rating, which is the top health category, and then you want to convert it to whole life insurance, let's say when you are 55 years old and you're not as healthy, maybe you wouldn't even be approved. Well, because you have that convertible term life insurance policy in place, you can convert it to whole life insurance and you won't have to go through any medical underwriting. The new whole life insurance policy is based on the health rating that you received with that convertible term life insurance policy when you were 40 years old or whenever you started it. So the benefit to a convertible term policy is that when I take that policy out, it's based on my health rating at that age, and then I can get a new whole life insurance policy at a later date by converting the term policy to a whole life insurance policy. Make sense? All right, so let's go through some details that are very important to be aware of. In most cases, someone who expresses interest in a convertible term policy is someone who has done their research around whole life insurance. They want it because they want to get as much cash value as possible to grow the cash value and use it tax-free down the road. Maybe they want to use it for real estate, whatever it might be. They know how the cash value works. They've done their research, but they're not in a position to start it right now. So they're interested in getting a convertible term policy. This way they can lock in their health rating and they won't have to go through underwriting later, which definitely has its advantages. However, there are some very important details to be aware of. So to go through this, we'll start by illustrating how a whole life insurance policy works that is maximized for cash value. So this is based on someone who is interested in a policy right now. And the goal is to get as much cash value as possible. This is the goal right here. So right here, this is not a convertible term policy. We're going to start with the basics, and then I'll go through the limits that a convertible term policy does have that can kind of be a turnoff to a lot of people. So here, someone wants to put in $50,000 per year. That's a lot to fund a whole life insurance policy with. His goal is to get as much cash value as possible. So what we do with that $50K is decide where it goes in the policy. We've got these three areas. What we want to do is minimize the premium as much as possible. That will maximize cash value. Here's why. Any money we pay into the premium, in this example, we're going to put $5,000 here. This does not show up in cash value in the first year. The reason why, because the insurance company is going to overcharge us for the cost of insurance upfront. So it might get us, call it $250,000 in whole life death benefit. So the premium dollars do not show up in cash value in the first year. We set it at $5,000 because the total out of pocket is $50,000. And when we look at some of the top life insurance companies, like your 4 major mutual companies, often the lowest we can set the premium is 10%. So 10% of the total out of pocket, or very close to that. All companies have different limits, but usually we'll see it right around that. Then next we'll add a term rider. This might cost $250 per year. This does not build any cash value, but it gets us another $750,000 in life insurance. Now, the purpose of adding this term insurance rider is that it prevents what is called a modified endowment contract, or MEC, from occurring, which is a taxable event. Why people are often attracted to whole life insurance is for the cash value, because if I set it up right and my policy does not become a modified endowment contract, I can access the cash value tax-free. That's why so many people and corporations are interested in this product and have used it for a very long time. So if we've got $250 going here, that is 0.5% of our payment when we look at it. So I'm just going to round here and say 1% toward the term insurance rider. And then we have what is called our paid up additions rider, where we'll put the other 89%. So if we put 45,000, it's going to be 44,750 bucks. That shows up in cash value in the first year. The next day, I see it show up in cash value. Not all of it. It's usually right around 95% or so. Sometimes it's a little bit higher. But that's money I can access right away, begins to compound. And this is really the key to maximizing the cash value growth with a whole life insurance policy. Now, it does get me some death benefit. In this case, if I put in 50 grand, maybe it gets me another $120,000 in death benefit. Somewhere between 2 to 3 times whatever my payment is, it will get me some death benefit as well, but not nearly as much as the premium. So let's go through an example of this. So this is for a 41-year-old individual. Here's what we're going to look at. A lot of stuff going on. Make this a bit bigger. And this is assuming he's doing his research right now. He's going to receive the top health rating, Preferred Plus. There we go. 41 years old. He wants to pay in $50,000 per year, only for 5 years. That's what he's interested in doing. His premium, right here, $5,000. So that's your premium. His term rider is right here, so a little bit more than $250. It is a 1-year term insurance rider, which we do recommend in most cases, as it opens up the PUA limits. For example, with this company and product, if I have this 1-year term rider attached, I can pay 10 times the base premium in PUAs. Whereas if I don't have this term rider attached, I can only pay 3 times the base premium in PUAs. PUAs are how I maximize the cash value. So the premium, $5,000, term insurance rider, which is right here, $250, and then the rest going into PUAs. Okay. Looking at this policy, cash value looks good. At $44,000 in the first year, breaks even between years 3 and 4. Okay, that's great. Here's what I want to hit on though. Look up at your premium of $5,000. Remember where we mentioned that gives you a whole life death benefit of $250K? Where do you see that on this? Right here. So $240,000 in change. This represents the whole life death benefit that is purchased from your $5,000 premium. And then below it, this is your term insurance rider, but the cost for the first year is down here. If you add those two together, you get a $1 million death benefit, which you'll notice is down here. So there's your $1 million death benefit. And your term rider will shrink as you pay money into the policy. So we're going to get back to the convertible term here, but this is all going to tie together. What's important to note is money you add into PUAs builds cash value, but it also builds your whole life insurance death benefit. And as the whole life death benefit goes up, Your term insurance rider here goes down. See it going down every year? And your net death benefit is staying at $1 million. What this means, if I look at the 5th year, you've got about 100,000 left in term. That means you've got 900,000 in whole life. 900 plus 100 equals a $1 million death benefit. Make sense? That's how a 1-year term insurance rider works. One goes up, the whole life death benefit, the term comes down, kind of like a seesaw. So let's very quickly look at a simplified version of this. So what do we have? This is the same illustration we just looked at. Base premium of $5,000, PUA rider of $45,000. There's the term insurance rider included in there too. Net out of pocket of $50,000. There's your total funding. Break-even point is between years 3 and 4 when you're cash positive. Whole life death benefit. This was not on the illustration. We added this column to make it easier. Term rider, add the two together. Your total death benefit is $1 million. The whole life goes up and the term goes down. And again, this is a standard whole life insurance policy. Here's the key takeaway here that I'd like you to focus on. This premium is $5,000. You're putting $45,000 into the PUA rider. This is what is maximizing your cash value. This is a very important item to be aware of when you look at a convertible term insurance policy, because if this is what you're expecting to convert a term policy to when you convert it to a whole life insurance policy, it could run into some surprises that you don't like very much. The reason why is anytime I convert a term policy to a whole life insurance policy, I've got limits. So if you have a convertible term insurance policy, the benefit is when you convert it to whole life insurance, there's no underwriting. You can just say, I got this term policy 15 years ago. I'd like to convert it to whole life insurance now. That's it. And then you fund it based on the limits and how much you want to fund it with. Here's the issue though. A convertible term policy often forces a higher base premium, which results in a lesser amount of your money going to paid up additions, which will result in less cash value. So if your goal is to get a whole life insurance policy for as much cash value as possible, we definitely want to be aware of this. Because if I look at a policy where I go through full underwriting, meaning I'm not converting a term life insurance policy, I can customize it and set the premium wherever I want. So my PUA rider can be maximized, the cash value can be maximized, which means I'll have more money when I look at everything, which is the name of the game. That's what people are often interested in. To give you a quick example here, all companies have different limitations. Here's one company. This is who we just looked at with the illustrations. And we have here converting to blended whole life. What blended whole life means is when I get that whole life insurance policy, got a whole life death benefit, a term rider, and I use the term because I want to minimize that base premium as much as possible, maximize the PUA rider, which gives me more cash value. So, what do I see here? Year represents how many years I've had the convertible term policy in force. I'll see if I'm converting it within the first 5 years. I'm less than 55. I've got this 1-to-4 ratio. What does that mean? Remember the illustration we looked at for the 41-year-old where he had a $1 million death benefit? How much was whole life and how much was term life? Let's go back to that. His whole life was $250,000. His term was $750,000. His total death benefit, add the two together, it's $1 million. Of $1 million, how much is $250,000 from a percentage standpoint? Let's look at it this way. So looking at this, total death benefit, $1 million. What's 1/4 of that? 250K. What's your whole life death benefit? Just about 250. It's actually a little bit less in this example. So what that is telling us is if we convert a $1 million death benefit to whole life insurance, the whole life portion must be at least $250,000, which if I'm converting it at an age older than 41, which is what we looked at in that illustration, it's going to force a higher base premium. What if I convert it after 5 years? For example, if it's 6+ years, and usually it's with this guy down here, well, then all of a sudden it's 1-to-1. And what that means is the whole life death benefit needs to be higher, which is going to force a higher base premium, which is going to force a higher commitment for me and also lesser cash value for me as the policyholder. I know that's a lot of information. Let's look at an example just to tie this together, because all of this is based on someone that we are working with right now that wanted to see a convertible term policy for himself. So the details we've got here. We've got someone who is 41 years old. He asked for a convertible term policy. He wanted to see a $1 million death benefit, and he wanted to convert that to whole life insurance at about the age of 55. That's the demonstration that he wants to see here. So let's take a look. What we'll do is pull up what we had before. So here's our illustration. Here it is on Excel. And what we're going to look at is a convertible term policy. So if we look at the actual term policy, what do we see? It's $940 per year. And this is for a 20-year, $1 million term insurance policy. The minimum premium is $860. What we attached is this extended conversion rider. That was for an additional $80 per year. And what that allows him to do is convert the term policy to whole life insurance for the full 20-year term. If we do not have that rider attached, then we can only convert it to whole life insurance for the first 5 years. So if I don't think I'm going to convert it to whole life insurance within the first 5 years, it's probably beneficial to attach that rider. That's why we did. And also, in this example, we're looking to convert it at year 15, which is when he is 55 years old. All right, a lot of information. I hope this is informative. What do we have here? Education around what to do with a whole life insurance policy to maximize the cash value. Can't get this right now though, so I'm interested in getting a convertible term policy. And then down here is when I think I can flip this over to whole life insurance. Let's look at the conversion. So we've got the conversion illustrations, both the PDFs and on Excel. So if I look at this guy, we've got a lot going on. I just want to hit on one thing on this. Remember that document where it said converting to blended whole life, and after 5 years, that 1-to-1 ratio? So what he wants to do is at 55 years old, he wants to convert a term policy that he had the top health rating with. So if he converts, he still has that top health rating. And he wants to pay $50,000 per year. He actually wants to go for 7 years if he starts it at age 55. So $50K per year is what he wants to pay in. Do you remember what his cash value was in the example we looked at if he started when he was 41 years old? It's about $43,000. Here, it's $32,000. Why so ugly? Is it because he's older? No, that's not why. 1-to-1 ratio. Total death benefit is $1 million. 50% of that needs to be whole life, and the other 50% can be term. If 50% of that total death benefit is whole life, that's going to force a higher premium than what I would normally set it at. Instead of a $5,000 base premium, got a $17,000 base premium. So what that means, if he does this, instead of committing only to about $5K per year at 55 years old, he's going to be committed to about $17,000 per year. That's his minimum commitment. And then also that $17,000 commitment in the first year does not show up in cash value. Versus what he wants is what we looked at before. But here it is at 55. This is what he would do if he went through full underwriting. 55, assuming he still gets preferred plus, 5K minimum premium, same death benefit. Look at the cash value, $43,000 and change. This is at 55 too, not 41. Age doesn't make much of a difference when you're designing all things equally. But 50K per year going in, here's the difference. There's your whole life death benefit. Instead of 500,000, it's 142, which gives him a 5K base premium, which that does not show up in cash value in the first year. But we minimize that instead of having $17,000 not show up in cash value in the first year. Does that make sense? I know it can be complicated. Let's simplify it a bit by looking at it on Excel side by side. So here's what we've got. First, we've got what he wants to do. So he wants to convert the term life insurance policy to whole life insurance. And what he wants is a policy set up for maximum cash value. So this, what we're going to look at first, requires full underwriting. So we can't convert the term policy to this, where he's got a $5,000 minimum premium, $45,000 PUA, total of $50 going in. There's the total funding in black. You can see by the fourth year, his cash value is equal to what he's paid. Then if we look at a breakdown of the death benefit, you see the whole life death benefit, 1 year term rider, which gives you a net of $1 million. And you can chop the term rider off after the 7th year to maximize the cash value growth. In this example, we're assuming he keeps it because the $1 million of constant life insurance is important to him, although eventually it will start to climb up. The thing about this, he can't have it with a convertible term. Even if he had a convertible term and said, okay, I'm 55, I'm going to convert this to whole life. If I can't have this, can I still do something with the convertible term? The answer would be no. It's as if I wasted it, or if the insurance company made an exception, which is possible, but not probable. When we look at it, that's not likely. So what I thought I could have, I can't get. This is why we looked at an example of him starting at 41 years old, because he saw how he could maximize cash value. So getting the convertible term to have this later and not be able to get it would not be a good thing. He'd be forced to do this if he wanted to convert. Base premium, $17,000 and change. PUA, $32,000 and change. Total funding, same thing, but the break even is not until between years 6 and 7. So it takes longer to get his money back. Now he starts out with a larger whole life death benefit when we compare this with this, which means he has less term, but the difference in cost is a couple $100. It's like, who cares? I'd rather spend a few extra $100 on a term insurance rider and have a much lower base premium, because that is what takes the biggest bite out of the cash value. There are the two side by side. A lot going on here. Let's look at a simplified view here. Difference in cash value. Here we go. So on the left, we've got a 1090 split, which requires full underwriting because we can't use a convertible term policy to get that. And then a 50-50 split, meaning if I get a convertible term and I convert it later with the intent of getting a whole life insurance policy for maximum cash value, the insurance company is going to say at least 50% of your $1 million death benefit needs to be whole life, which means I'm going to have a higher premium and less cash value. This is going to show how much more or less I have in cash value with this option compared to this option. Same company, same product, everything's identical, just the difference is in the premium and PUA blend. And what do you notice? You have less money in cash value from start to finish by going with the higher base premium, which is typically always the case. So, what's the lesson here? Should I get a convertible term policy? If my goal is to get a whole life insurance policy and I want as much cash value as possible, and I want to minimize my base premium, maximize the PUA rider, probably not. Now, if I'm concerned that I could have a life event where I'm no longer healthy or eligible to be approved for a whole life insurance policy down the road, well, a convertible term can protect me from that. The thing is, I just want to have things be made very, very clear as far as what I can and cannot do with that term conversion. This way, I don't get a convertible term policy thinking that I can flip that over to a whole life insurance policy with a minimum base premium, maximum PUA rider to maximize the cash value, and then I'm told that I can't. Because if that's me, I'm going to feel like, wait a minute, the whole purpose I got this convertible term is so I could later get a whole life insurance policy that was set up the good way for cash value. And now you're telling me that I can't? Feels like a bait and switch. It's not. It's just the limits that are imposed by the insurance company. So I do want to have the awareness around what is and is not possible. One thing I might do if health is a concern, I might get a convertible term policy, keep that in my back pocket. This way, when I come toward the end of that convertible term, if I do have a health issue and I want a new whole life insurance policy, at least I can convert this to whole life insurance. It won't be optimal, but I can still get a permanent policy and still do my best to maximize the cash value. However, if I'm healthy, I probably am going to end up wanting to go through full underwriting because what I get is a lot more value when I look at the cash value, especially upfront and long-term too. So I hope that you enjoyed this video. I know there was a lot of detail in here. I would love to hear any thoughts that you have. Please let us know any thoughts in the comments below. And as always, I hope this helps. Thanks so much.